Welcome to the KP Podcast, where we talk about the business of real estate. A podcast about leveraging opportunities, growing your business, and experiencing financial freedom. Here are your hosts, Keith Anderson and Peter Cambucos.
Hey everyone, welcome to the KP Podcast. I'm Pete here with Keith, and it's good to be back, man. How are you doing?
We are doing good. We are doing good. Big day today. The weather's starting to get nicer and nicer daily.
So I always say, this is Arizona's time to shine. For those of you listening in the rest of the country, when we're talking about how hot it is here in the desert in July, well, right now, I would say like January, February, March, even into April, this is prime time. This is the stuff when, we got Barrett Jackson in town. The Phoenix Open's coming.
Super Bowl's here every other year.
Super Bowl's going to be here next week. Spring training's coming. Like, tons of people. We got all the snowbirds. Everybody's here because it is beautiful. Well, I hear they're getting a snowstorm in the Northeast today.
I think
it's 70 degrees.
I was talking to my wife, and she was talking to her family back home, and her dad reached out to her and said, "It's warming up today to positive degrees." It's we're getting a warm front. It's going to be 3 of a high today. Yeah,
Golly.
It was bad.
So we're blessed. It's good. Yes. It's good to be here. But let's get into today's topic for those that aren't in Arizona, or for the ones that are. We got some stuff going on in the world. Stuff that this is now things that you're hearing about in mainstream media, not just in financial things or investor stuff. It's popping up even on like the late shows and stuff, which means that this is now a topic that is in and affecting everyone's life, and we're talking about inflation.
Well, it's also something that's been happening a while, but it's been pushed under the rug for long enough that no one wants to talk about it on the late show. So the key is when you start hearing about it on Saturday Night Live, the late show, wherever you're at, that means it's been happening a while.
Oh yeah.
And so it's now a topic of discussion, and people even that don't follow a lot of news are starting to see. When that happens, then you actually have a big deal, and it's starting to become a bigger realization for others. And inflation has been around for as long as we remember. So the key is grades of inflation. At what degree is it happening, right? And that's what we're going to talk about today. Basically, everything about inflation.
Yeah, and more specifically for our audience is how to make inflation work for you. So, okay, it's here. What are you going to do about it?
Is inflation always a bad thing?
Depends on who you are.
And I think that's the biggest thing is the media and the world will always point at inflation's bad, this is bad, oh no, pity us. But yet people are still out there on a daily, weekly, yearly basis taking advantage of different markets, just like anything. Think about a stock and stock prices. Stocks go up, stocks go down, things change, right? You don't have to. It's not only good when stocks go up or only good when stocks go down. That's not the case. Your strategy changes, but there's always positives and negatives in every type of a marketplace. The key is what side you're going to be on. So, Pete, let's start with this. What is inflation?
Yeah, let's make sure we're all on the same page, right? When we're getting going here. So first, I jotted down this quote from Ronald Reagan, right? So President Reagan, and he said, quote, "Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman."
That doesn't sound good.
That doesn't sound good.
That doesn't sound like this could be a positive opportunity for people.
So, the thing with inflation that we talk about is it steals from you. It steals purchasing power. So inflation it means that you need more currency to get the same thing as you were before. So,
let's give an example.
Let's give an example. So let's use something super small, right? So we're looking at
they use milk all the time, right? A gallon of milk.
Sure. I was going to say, let's use a candy bar and just do $1, right? So let's say a year ago, you were going to buy a Snickers bar, and I don't know, let's assume it was $1, right? So a year ago, $1 would buy you a Snickers bar. Here we are a year later, we've got highest inflation rate in 40 years, official numbers about 7%. So what does that mean? It means 1 year later, today, it costs you $1.07 to buy the exact
$1.07.
$1.07 to buy that exact same Snickers bar. So you lost purchasing power, because if you had that dollar and you just threw it in the desk drawer from a year ago and it sat there, and then you pulled it out or you found it. Let's say you found it today, right? You go out there, you're like, I'm going to go get myself a Snickers bar. Well, now you can't. You can't. That dollar does not buy you what it did 1 year ago, and that is inflation. Yep. And that's why Ronald Reagan says all of these things about it, because it steals from you. It steals your purchasing power.
An easy one that I always reflect on when I think of inflation is my dad used to tell me all the time, because this is when your parents start to say, well, back in my day, when you start to hear that, what that really means is back when inflation was less. Yeah. That's really what that comment is. And so the one that he would say all the time, because I like burgers and I like Burger King and he does too, is he's like, back in my day, I used to get 2 Whoppers for $1. That was the special. Now it was 2 for $5 or $7 a piece, but I used to get 2 for $1. Mm-hmm. Now, and that was what, the 80s, mid 80s. But I mean, it's just hilarious when you think about it. It's like, that's just our modern way of seeing inflation. And we don't really recognize it because it's not as prevalent to us. Like, we don't see
it
that.
Hasn't been, right?
Hasn't
Up
been.
Until now.
But now people are starting to shine a light on it again. And so let's use our actual buying power. What has happened with inflation? What are the actual numbers? We're using examples, but what are we actually looking at, Pete?
Yeah, and because I think a lot of people don't realize it, right? So I think it's important to talk about where we are now and then look back at that. So like you said, at this point, we're seeing it. We have the highest inflation rate we've had in 40 years. The official rate of inflation at this point is almost 7%.
Wow.
However, as everyone knows, and this is a fact because the government themselves admits it, they've changed over the years how they measure inflation. So if we go back to the old way that they used to measure it, the real rate of inflation is probably closer to like 15%.
Yeah.
And so we've got these really high rates, but like you said, let's look at these other numbers. So let's look at in the last 50 years or so, roughly, if we go back to 1970, $1 in 1970, $1 is the equivalent of 13 cents today. So that means that the dollar since 1970 in about the last 50 years has lost 87% of its buying power.
So, that's literally the Whopper we're talking about right now, isn't it? So what that would mean is what you would be able to buy for $1 is now going to cost you $7.19.
Yes, that's another way to put it as you're looking there. So what cost you, or what you could buy, I should say, with $1 in 1970 today to buy the exact same thing. So let's say it was a Whopper. That Whopper cost you $1 in 1970. Today, that Whopper costs you $7.19. So you need 700% times more of that money to buy the exact same item.
Now, granted, that's, 50 years, right? Mm-hmm. So like we're seeing a massive movement over the last 50 years, which you're going to expect, moderate inflation over time, right? And especially when the government has so much debt. But again, the light's being shined on this. Now, they have other things balancing out. Wages go up, right? And moderate to keep up with it, because you can't keep making $1 an hour, but buy stuff that costs now $7. However,
but they haven't kept up, which has been the problem, right?
So that's my question is, okay, so we're seeing inflation be that high, but how has wage inflation been moderately to or compared to the actual rate of inflation?
Way below. So wages haven't kept up with inflation anywhere near that. I don't have the numbers in front of me, but it's way off. So if you think about it, like we say, the purchasing power has gone down by 87%. Well, the question you're asking is, have wages increased that much over that time or gone up by the same percentage to keep up with it? No, not even close. So
there you go.
That kind of brings us to some of the next things that we're talking about, which is, well, then who does this hurt? Who does this help? And what do you do about it? And what have people historically done about it? Now, one of the things, again, as we're seeing this all in the media right now, and I'm sure, I know the Fed just met yesterday as we're taping this, and they're talking about, raising rates to combat this inflation. They're talking about that first rate hike in March, so it has all of these effects on the economy, and, what are we going to do about it? And it's, if they let it get away, if they let it keep going, then, it hurts that purchasing power, hurts the economy, because it'll either people won't be able to afford things or will cause that wage inflation that you're talking about, right?
Yep.
So again, so let's go back to, like I said, so who's it hurt and who's it helping? What do you do about this? So we just said that the wages haven't kept up in the last 50 years. So people that are just consuming, that are just working, they've been, and people, frankly, that are just saving and not doing anything else, they have been losing. They've been losing purchasing power. So each year has progressively gotten worse for these folks.
So their mortgage gets more expensive. The things they're buying gets more expensive, and their budget is kind of diminishing.
Well, new mortgages, sure. But yeah, I mean, obviously, a fixed rate mortgage is, we'll get into that later. But yeah, I mean, it costs them more to buy food. It costs, they got to get a new car or their rent or whatever.
Your budget's just
all that's going up.
Get tighter.
More than your wages are going up, right? So, but, what we're talking about today is there are people that are benefiting off of this. Well, how do you benefit off of this? And this is the whole point of what we're saying. How do you make it work for you? Well, think about what we just said, all right? All of those people have these costs going up due to inflation. And what do we just say? Rents are increasing, prices of the cars, price of the food. All of those are real items, right? They're real assets for somebody. So if you think about it that way, if some people are losing on one side by having to pay more for those, well, whoever has those on the other side, they're increasing. So the people who have, the real estate and the cars and the tangible assets and the commodities that go into the food, their assets, their tangible items, their real assets that they're owning, those are being driven up by inflation, right? So as things inflate, those people are actually, their money is increasing with that inflation.
Yeah, the value of a lot of these properties. So let's paint that picture, right? So you have a property and maybe it's your own primary residence, let's just say, and your value is increasing a little higher. We saw a massive year this year, right? We saw 30% appreciation rates
in the Phoenix market.
In the Phoenix metro market. Now, that's crazy, first off, but it starts to shed a little light when you see inflation moved as much as it did as well.
Right.
That contributes to the factor of appreciation. So a lot of people are thinking like, oh, well, if I own my house outright for cash and then my house is moving up in value, and yes, that is correct. But we're still running into the same issue of what is the ultimate win when it comes to owning hard assets in an inflated market. And that really comes down to debt, because there's two sides of that coin, right? When debt stays the same, the value of that debt in an inflated market, it's less and less against you because of the fact that, let's say you have $100,000 worth of debt. Well, if the market inflates 7%, your debt didn't inflate. It stayed the same. So your buying power based on your asset, it consuming more of that debt over time. Yeah,
another way to put it, and you're right. So if you go, and I guess, just to kind of recap that, so what should you do, right? You're talking, like you said, buy real assets. And so those are things that are real tangible things. The biggest one, and obviously the one we'll focus on, is real estate.
Easy.
But you have, like we said, the commodities, land, precious metals, equipment, natural resources, vehicles. These are all things that are real tangible assets that get driven up by inflation.
That aren't getting consumed quickly and effectively.
Correct. And so the point that you're making is a big one, which is using debt. And you have to be careful because debt can be a double-edged sword. Mm-hmm. But if you're locking in fixed rate debt that's covered, the type you're using with, say, investment properties like rental real estate, then your debt over time gets destroyed. So the inflation is helping you. Not only is the value of your property going up, but your debt, like let's say you locked in today at 4%. Well, inflation's at 7%. You know what I mean? So basically,
if they're borrowing at 4,
you're borrowing at 4, and they're devaluing the currency at least 7%. So by that, just having that debt, you're 3% in the positive before anything.
Yep.
You know what I mean? So a year later, let's say, just use that dollar example. They go, okay, well, that dollar is going to cost you $1.04, but if they devalue it by 7%, you're paying back with even cheaper dollars. So the debt that you fixed now becomes worth, or is a smaller and smaller percentage and a smaller hit to you. Looking at it another way, we said the example before, $1 from 1970 has the equivalent buying power of 13 cents today. Let's just pretend there was this 50-year mortgage and you borrowed, $100,000 in 1970. If you're still paying on that mortgage today, just to prove the example here, you're paying each dollar you're paying back basically the equivalent of 13 cents.
Yeah. So when you give them 13 cents, they're taking $1 off that mortgage, if you will, in a weird way.
Yep.
And that's the easiest way to look at it. It's no different than saying you still have that $100,000 worth of debt, but now you have $700,000 that you borrowed. Essentially, it's a lot easier to pay off that debt because you were able to let that money grow. That's not even taking into account the actual investment opportunity of making that money work for you. We're just talking about base inflation right now.
Right.
We're not talking about you getting a cash flow or any type of income from what the money that you're borrowing is doing.
And you hear it from some folks. Sometimes it's hard to wrap their head around because, like you said, debt can be a double-edged sword. But one of the things that Keith, you and I have talked about quite a bit is the world is a very, very different place than it was 30, 40 years ago. And this is the concept with this when we talk about how to get inflation to work for you, that we want everybody to grasp. If you listen to this, hear this one part. The world is not the same as it was 30, 40 years ago. And what do we mean by that? If you listen to your parents, your grandparents are going to tell you, save your money,
put it in the bank,
stay safe, don't take on a lot of debt. At one time, that was good advice because we had high interest rates. In 1980, mortgage rates, for example, were approaching 18%. You could have money in the bank earning 12 to 15%. So saving money at that point made sense. But today, you can't even get 0.5% in the bank. And the point is, if you're saving just currency, just dollars, you're losing. If you just leave your money in the bank, the government and the currency, the inflation is eating away. You're losing 7% just by having it sit in the bank. Yep. So you want to hedge against that. You want to have something that's going to produce, a positive return above that inflation rate just to stay even. Think about that. You need something that's going to go up at least 7% just to maintain. You're not even making any profit or increasing at that point. You're just not losing. Yeah. And so it's a very different world. It's sad to say. No, and I guess the thing to make clear is it's not good. It shouldn't be this way. Savers should be rewarded, but that's not the world we live in. And so we can sit here and talk about how things should be, or we can just say this is how they are. And today, debtors are being rewarded and savers are not. Savers are losing.
It's very easy when you start to wrap your mind around the fact that investing and growing your entire portfolio is a game. Okay. Well, over the course of time, rules change. The game changes. Things alter your outlook. It happens in sports all the time. What we see football today is an easy example. They don't play the game the exact same way they did in the 1970s.
Right.
Plays changed. The way to move around changes. Rules have changed over the course of time. Look at the passing that we see in the NFL. Just to kind of give you kind of that example, they used to run the ball almost every play.
Yeah.
And now they pass the ball almost every play. The goal is still the same. The goal is to score touchdowns. It's to make money in investing, right? To increase your portfolio. The goal is still the same. The difference is the way you should go about doing it has changed. Maybe you shouldn't be running the ball slowly, methodically in a savings account now. Maybe you need to adjust the way you attack this game and play it differently based on the rules and the defenses coming at you. Right now, the world economy has a different defense. That's all it is. You just have to attack it a little differently.
Yeah, and things will change in the future. Who knows to what extent and where it'll go. But we've got to play with what we've got now, like you said. And so, could there be a time, again, when we have really high interest rates and saving makes sense and taking on a lot of debt doesn't? Absolutely. But that's not the world we're in now. And who knows when we'll get back there, if we ever do. So if we're playing with what we've got now, we know as a fact, the one thing I think that's undeniable is inflation is here. What the question is at what levels, at what rate, so we can argue about, and people can debate about, hey, is it going to be, another quote 7% official number or 15% unofficial, if you will, or is it going to come down from that? Yeah, it's probably, who knows? I don't know.
Spotlight's on it now, so
yeah, but I mean, exactly. Is it gonna be lower this year than that? Probably, but the fact is, it's still there.
Yep.
So if we say, oh well, it was only 4% or 5%, fine, it's still there, and so you still have to attack it that way. It's just like you said, the spotlight's on it now because it got so out of whack and so high. But that's the only real question that we've got to know right now is. It just depends on what level because it's here and it's staying here.
I think our biggest point looking at this is be mindful of very, very, very long-term investment strategies because things change over time, right? Your strategies should be broken down in multiple factors. You have your long plays, you have your middle length plays, and then you have your short-term plays. Those will all probably need to adjust, right? So people that had put their money in their account, like we talked about 50 years ago, in the long play that one day they'll retire, their savings account will be big, they gained all the interest. Well, over the last 20 years, that has slowly changed and the interest rates have adjusted. So that long play strategy would have needed to adjust to take a full effect, and a new long-term strategy would have to be played out. So just keep that in mind that things have to adjust, and we use this script all the time. We use the same language, and it's what got us here today is not what's going to take us there tomorrow. We cannot keep playing the same game. And what we use the other saying we say all the time is, what's the definition of insanity? It's doing the same thing over and over again, expecting different results. And when things aren't working in a changing market, you can't keep playing that same game. You got to look for a different strategy to fix what's not working.
Yeah. And so, just to touch on here before we go. So we're talking about what should we do? It's not only real assets, but how we feel about it. It's, cash flowing investment real estate is one of the most proven asset classes and one of the best hedges against inflation, because we haven't even touched on, the fact of the leverage ratios that you've got. If you buy $100,000 house for cash and that goes up or inflates, however you want to look at it, by $10,000, over the course of a year, that went up 10%. Your money went up 10%.
So you made what, 10 grand?
10 grand, it went up 10%. However, if you put debt on it, and again, what we're talking about is fixed rate debt, because the rates will be higher from here. So fix in these low rates now that are lower than inflation. But you've got fixed debt, you've got rental income coming in, as we call covered debt, right? So someone else is paying your mortgage. House price goes up or down, doesn't matter. It's cash flow, and that cash is coming in from those tenants covering it. So if you put 20% down on that same $100,000 house, you didn't put $100,000 in there, you only put $20,000 in. Well, the appreciation rate isn't changed by how much you put in, right? So it still goes up $10,000, but the difference is now you just made $10,000 on your $20,000. So your rate of return there was 50%, not 10%.
And using those exact same numbers, just let's say you have $100,000 and you needed to spend the $100,000, it would be no different than instead of buying $100,000 worth of leverage, using the same 20% strategy, you just now bought $500,000 worth of leverage. And that's the other side of the coin. There's two ways to look at it. You can either invest less for the same leverage or leverage way more money or more assets, or the same as what you were going to plan on buying cash. But now you have $500,000 moving at that same rate. Instead of making only 10 grand that year, you made 50 grand using that same exact investment, the same percentage of 50%. But the difference is you're learning to use those leveraged assets. So in an inflated market, fixed and covered debt is fixed rates with covered debt is immensely popular. And so it changes the game on what you want to do strategy-wise.
Use it to your advantage. That's what it comes down to. So to sum it up, buy real tangible assets, lock in the low rates that we've got right now. And if you're using debt, yes, you want to be careful and safe with it. That's why you're using fixed rate debt and it's covered, meaning by cash flowing properties. If you're getting real estate, make sure your debt's being covered. So use that and make inflation work for you.
Awesome, guys. Thanks for joining us today. Again, follow us on YouTube, Instagram, and Facebook, and send all your questions to questions@kpleadaz.com. And we'd love to hear your strategies on how you're using and leveraging inflation to make your profile or portfolio work. We'll see you guys next time.
See you guys.